Hi, and welcome to another session. In this session, we will be learning the rules for debit and credit based on the modern approach. There are two approaches in which the rules of debit and credit have been given. So the first one is the traditional approach and the second one is modern approach. As per the traditional approach, the accounts are classified as real account, nominal account, and personal account. And as per the modern approach, the accounts are classified as assets, capital, liabilities, expenses and losses, incomes, and gains. The videos explaining the rules as per the traditional approach have already been uploaded on the channel. The link of that would be provided in the description box below. In this video, we will be looking at the rules based on the modern approach. In this video, the format of the journal is the one which is used in Indian boards. So this video is for those who are studying in Indian boards. That is, if you're doing your CBSE, ICSE, BCom, or you're doing any other Indian board. For those studying in Cambridge, a separate video has been made for you. The link of that is provided in the description box below. In this video, accounting formats have been explained. I would request you to watch the video in the full screen mode so that you can have a better view of the formats. It would be good if you could keep a paper and pen with you so that you can make a note of the new points you come across while you are watching this video. As per the modern approach, the accounts are classified as assets, capital, liabilities, expenses and losses, and incomes and gains. Now, let's have a look at the rules. So the rule for assets is debit increase in assets and credit decrease in assets. Whenever a business buys assets, the asset in the business increases. Therefore, you will debit it. And whenever the business is going to sell an asset, that's the time when the asset in the business is going to decrease and we will credit that entry. We will be taking transactions ahead and applying the rules and then posting them in the journal. Right now, we will just have a look at the rules. The rule for expenses and losses is debit increase in expenses and losses and credit decrease in expenses and losses. So whenever a business is going to incur expenses or there is a loss, it needs to be debited. And whenever there is a decrease in expense, then you need to credit it. The rule for capital is credit increase in capital and debit decrease in capital. So when the capital is going to increase in the business, it needs to be credited. And if there is a decrease in the capital, it needs to be debited. Now, capital is the money that is invested by the owner. So when the owner invests money in the business, capital is increasing in the business. Therefore, it should be credited. And if there is a decrease in capital, for example, if the owner withdraws money from the business, then there is a decrease in capital that needs to be debited. So for capital, credit increase in capital and debit decrease in capital. The rule for liability or liabilities is credit increase in liability and debit decrease in liability. So whenever there is increase in liability, it needs to be credited. And whenever there is decrease in liability, it needs to be debited. So example of liability is borrowing. So whenever the business is going to borrow or take a loan, your liability is increasing. Therefore, it needs to be credited. And when the business repays this loan, your liability is decreasing. Therefore, it needs to be debited. The rule for income and gains is credit increase in income and debit decrease in income. So here we've just read the rules. Now we will move ahead, take transactions, identify the two accounts involved, and then apply these rules and record them in the journal. So here I have made this chart. So for assets and expenses, whenever there is an increase in them, it needs to be debited. And If there is a decrease in assets and expenses, it needs to be credited. Same way for capital, liability, incomes and gains. Whenever there is going to be an increase in these three, you need to credit. And if there is a decrease in them, you need to debit it. So this is an at a glance of all the rules that we just read. Before we move ahead, let's have a look at the format of a journal. So your journal looks like this. First, you have a date column. The second column is the particulars column where you will record the journal entry. Then this is the ledger folio column. In the ledger folio column, you record the page number where this entry is posted in the ledger. First, you record the entries in the journal, and from the journal, you post the entries in the ledger. So where exactly in the ledger you have posted, you are going to record that over here. Then this is the column to write the debit amount, and in this column, we write the credit amount. Now that we are familiar with the format of the journal, let's have a look at the structure of a journal entry. So here you will mention the date of the transaction. Then in the particulars column, there are three things that you need to write. First, you need to write the account to be debited, followed by abbreviation A/C, which stands for account. And then over here, that is next to this margin, you will write the word DR, which stands for debit. So this tells that this is the debit entry. So account to be debited, followed by A/C and DR over here. Then in the next line, you would leave some space. Then you would always start by writing the word to. Then name of the account to be credited, followed by A/C. And then in the next line, you write narrative. Now, narrative is a brief description of the entry. A narrative is always written in bracket, and it starts by the word being. So you'll put a bracket, you will first write the word being, and then a small description of the entry is what you would write, and that's called a narrative. This is the ledger folio column, and in this column we write the page number where the entry would be made in the ledger. In your questions, because you're just learning how to record the entries, we are going to leave this ledger folio column blank. So account to be debited first, and then in the debit amount column you write the amount of this entry, then account to be credited and the amount to be credited in the credit amount column, and then the narrative. Now that we are familiar with the format of the journal and we have an idea about the structure of a journal entry, let's take a transaction and record it into the journal. For each of the journal entries, we are going to follow certain steps. So first, we will read the transaction. Once we have read the transactions, we will identify the two aspects or two accounts involved. Now, accounting is based on double entry system of bookkeeping. And as per double entry system of bookkeeping, every transaction has two aspects. So there is going to be a debit aspect and a credit aspect. So once we have read the transaction, then we will identify the two aspects or the two accounts involved. After doing this, we will identify the class of each account or to which category does the account belong. So is it an asset, capital or liability, expense or income? That is what we are going to identify. Once we have identified the two aspects and we know the class of each account, then we will apply the rules that we just saw in the video, and then we will record the entry. Now, let's take a transaction and record it into the journal. So the date is January 1 and the transaction is purchased land and paid through cash rupees 80,000. Now, if you remember the steps, the first step was to read the transaction and the next step was to identify the two accounts involved. So here the business is buying land and it is paying cash to buy this land. So the two accounts involved are land and cash. So purchased land and paid through cash, and the two accounts in this transaction are land and cash. As you are new to accounting, it would be good if you could do a little bit of rough work before you actually post the entry in the journal. In accounting, the rough work is referred as working notes. So you can create this table on one page, and on the next page, you can draw the format of the journal. So once you have done your workings over here, it would be very easy for you to record the entry in your journal. The columns in this table are date, accounts involved, the nature of account, rule, a column to write the debit amount, and a column to write the credit amount. So here we will write the date, then the two accounts involved. And what were the two accounts involved? Land and cash. Now land is a resource for the business. Therefore, it is an asset for the business. So in nature of account, we will write assets. Cash is also a resource for the business. Therefore, cash is also an asset for the business. So the two accounts are land and cash. Land is an asset for the business and cash is also an asset for the business. And what was the rule for assets? Debit increase in assets and credit decrease in assets. Now the business is buying land, therefore land is increasing. So in rule we have written the effect that land is increasing. And in order to buy land, the business is paying cash. Therefore, the cash balance in the business is decreasing. So land is an asset. As the business is buying land, it is increasing. Cash is also an asset, and as the payment is made in cash, therefore the cash balance in the business is decreasing. And what was the rule? If there is an increase, you debit it. Therefore, land account needs to be debited by 80,000. And if there is a decrease, it needs to be credited. Therefore, cash account needs to be credited by 80,000. Let's do it one more time. So the two accounts involved are land and cash. Land is an asset. It is increasing because the business is purchasing land. Therefore, land account needs to be debited. Cash is also an asset. The payment is being made in cash. Therefore, it is decreasing. So cash account needs to be credited by 80,000. Now that we have done the working, let's move ahead and record this in the journal. So just next to the page of working notes, you can draw the format of journal on one page and you can record this entry. So the date is January 1. So what was the structure of a journal entry? First, the debit entry, then the credit entry, and then the narrative. So the account to be debited was land. So land followed by the abbreviation A/C and the word DR just here. Okay. And then in the debit amount column, the amount 80,000. In the next line, we will leave some space, then the word to, followed by the account to be credited, which is cash in this case, followed by abbreviation A/C. And then in the credit amount column, the amount 80,000. And the narrative is, and what did I say about narrative? It has to be in the bracket and it needs to start with the word being. So the narrative is being land bought by cash. Let's do it one more time. January 1, land account debit. In the debit column 80,000. In the next line, we would leave some space and then to cash account. And in the credit amount column 80,000 and the narrative is being land bought by cash. Now you have to remember that you have to follow the structure of the journal entry. You cannot change it. For example, you cannot write the credit entry first and then the debit entry. You have to stick to the structure. Now, let's take one more transaction and record the journal entry. So the transaction is January 3rd, purchased machinery worth rupees 35,000 from Anand on credit. So the first step was to read the transaction. And now that we have read the transaction, let's identify the two accounts involved. So in this transaction, what is the business doing? The business is buying machinery. So the first account is machinery. And how is machinery being bought? Well, the machinery is being bought on credit. And from whom? From Anand. So the first account is machinery and the second account is going to be of Anand. So the two accounts involved are machinery and Anand. Now let's do the workings. So here this is our working notes. So we've already made this table for the first entry. So you can just leave a line and then do the rough work for this entry and then record it in the journal. So you would leave a line and then you will write January 3rd. What were the two accounts involved? Machinery and Anand. So here we will write the two accounts involved. Now machinery is a resource for a business, therefore it's an asset. And from Anand we have taken machinery on credit. So in a way we have taken a borrowing or a kind of loan from Anand. Therefore it is the liability of a business and the business needs to pay back this money to Anand. Therefore, the money that the business needs to pay to Anand becomes a liability for the business. So, we will write the name Anand over here and the nature of account is going to be liability. Let's do a quick recall of the rule for assets. So, what was the rule? Debit increase in assets and credit decrease in assets. So here the business is buying machinery. Therefore, there is increase of machinery in the business. So in the rule we will write increase. And as per the rule, the machinery account needs to be debited by 35,000. So the account is machinery. Machinery is an asset. There is increase in asset, and whenever there is increase in asset, it needs to be debited. Now the second account is of Anand. It is a liability for the business, and there is increase in liability. Why? Because you have bought on credit from Anand. Therefore, there is increase in liability. And what was the rule for liability? Credit increase in liability and debit decrease in liability. And here the liability is increasing. Therefore, it needs to be credited. So let's do a quick recap of this. So the two accounts involved are machinery and Anand. Machinery is an asset for the business. It is increasing. Therefore, machinery account needs to be debited by 35,000. The second account is of Anand. It's a liability. There is increase in liability because we've bought on credit from Anand. And whenever there is increase in liability, it needs to be credited. Now, let's record this entry in the journal. So, you've already drawn this format. You would leave a line and then you would record this entry. Why? Because in a journal, you record entries date-wise or in chronological order. So first you recorded the entry of January 1 and now you would leave a line and you would record the next entry. So you have the working notes on one page and the format of journal on the next page. So the date is January 3rd. First, we would write the account to be debited. So machinery followed by A/C and then the word DR over here. So machinery account debit and in the debit column 35,000. In the next line, we would leave some space. We would always leave some space. We're not going to start from here just below machinery. So we would leave some space. Then the word to and then the account to be credited, which is Anand in this case. So to Anand's account and in the credit column 35,000. And the narrative is being machinery bought on credit. So machinery account debit 35,000 to Anand's account credit in the credit column 35,000 and the narrative is being machinery bought on credit. Now let's move ahead and record the next transaction. So the date is January 5 and the transaction is introduced capital in business rupees 1,50,000. So in this transaction, the owner has introduced capital in the business. Now that we have read the transaction, let's identify the two aspects or the two accounts involved. So the first account is capital. The owner is introducing capital. And what is he giving? He's giving cash to the business. Therefore, the second account is cash. So the two accounts involved over here are capital and cash. Now that we have read the transaction, let's do the workings. We've already done few workings, so you would leave a line and then do the workings for this transaction. So the date is January 5th. The two accounts involved are cash and capital. Cash is a resource for the business, so it's asset, and capital is the money that is introduced by. Over here, the nature of account is also going to be capital, because if you recall, what were the 5 categories? Assets, capital, liabilities, expenses, and income. So here you will write capital. The owner is investing more money in the business. So cash is increasing in the business. And what was the rule for assets? Debit, increase in assets, and credit, decrease in assets. Therefore, cash account needs to be debited by 1,50,000. Now let's move to the second account. So the second account is capital. The nature of account is also going to be capital. And what was the rule for the capital? Credit, increase in capital, and debit, decrease in capital. Whenever the owner is going to invest more money in the business, the capital in the business is increasing. So here we will write increase. And as the capital is increasing, based on the rule, the capital account should be credited. Let's do it one more time. So the two accounts involved are cash and capital. Cash is an asset for the business. It is increasing in the business. Therefore, cash account should be debited. So here the second account is capital, and the nature of account is also capital. Capital is increasing in the business, and whenever there is an increase in capital, it needs to be credited. Now, let's record the entry in the journal. So you would leave a line and then you will record this as the next entry. So the date is January 5th. The account to be debited is cash. So cash account and then debit over here. And in the debit amount column, we will write the amount 1,50,000. In the next line, we would leave some space and then the word to, then the account to be credited. So to capital followed by A/C, which is account. So to capital account, and in the credit column, 1,50,000. And the narrative is being capital introduced by the owner. So cash account debit, in the debit column 1,50,000, then leave some space to capital account, and in the credit column 1,50,000, and the narrative is being capital introduced by the owner. Now let's record the next entry. So the entry is on January 6th, sold goods worth rupees 30,000 in cash. So the first step is to read the transaction. Now that we have read, we need to identify the two accounts involved. Whenever a business is going to sell goods or inventory or stock, the name of the account you are going to use is going to be sales. So you're not going to write sold goods over there. The name of the account is going to be sales. So here the first account is sales, and when the business is selling goods, what are you getting in return? You're getting cash. So the second account is cash. So the two accounts involved in this transaction are sales and cash. Now let's do the working notes and then record the entry in the journal. So you would leave a line and then do the workings for this transaction. So the date is January 6th. The two accounts involved are cash and sales. Now cash is a resource for the business, therefore it's an asset. Sales is revenue for the business, so it is income for the business. And what was the rule for the asset? Debit, increase in asset, and credit, decrease in asset. So here, when you sell goods, you're getting cash. So cash is increasing in the business. Therefore, there is increase in asset. So we've written increase over here. So we need to debit cash account. Cash is an asset, and whenever there is increase in assets, you debit it. So cash account would be debited. Now, sales is an income. And what was the rule for income and gains? So the rule was credit, increase in incomes and gains, and debit, decrease in incomes and gains. When the business does sales, there is increase in income. So in the rule column, we have written increase. And what do we do when there is increase in income? We credited. So sales account would be credited. So the two accounts are cash and sales. Cash is an asset. There is increase in asset, therefore cash account needs to be debited. Sales is an income. There is increase in sales because the business is selling more. Therefore, sales account should be credited. Now, let's record the entry in the journal. So you would leave a line and you will record this entry. So the date is January 6th. So the account to be debited first. So cash followed by A/C. Then the word DR over here. So cash account debit. In the debit column, 30,000. Then in the next line, you would leave some space. Then the word to followed by the name of the account to be credited. So to sales account. And in the credit column, 30,000. And the narrative is being inventory or goods sold in cash. So cash account debit 30,000 to sales account credit, and in the credit column 30,000, and the narrative is being inventory, or you can also use the term goods sold in cash. Now let's move ahead and record the next transaction. So the transaction is on January 7th, purchased goods worth rupees 40,000 in cash. When the business buys goods, the name of the account you are going to use is going to be purchases. So when a business sells goods or inventory, the name of the account is going to be sales. And when the business buys goods, inventory or stock, the name of the account is going to be purchases. So here, the first account is purchases. So the business is buying goods and paying by cash. So first account is purchases and the second account is going to be cash. How are we paying for this transaction? We are paying by cash. So the two accounts are purchases and cash. Now let's do the workings. So you would leave a line and then write the date January 7th. The two accounts involved are purchases and cash. So purchases is an expense for the business. Therefore, in the nature of account, we've written expenses over here. And what was the rule for expenses? Debit increase in expenses and losses, and credit decrease in expenses and losses. Here, the business is purchasing goods. Therefore, there is increase in expense. So purchases account should be debited by 40,000. The second account is cash. Cash is an asset. We are paying for these goods. So there's a decrease of cash balance in the business. So cash account needs to be credited. Let's do it one more time. The two accounts involved are purchases and cash. Purchases is an expense, and whenever there is increase in expense, we need to debit it. Therefore, purchases account should be debited by 40,000. Cash is an asset. Whenever there is decrease in asset, we credit it. Therefore, we need to credit cash account by 40,000. Now, let's record the entry in the journal. So you would leave a line and you will record this next entry. So date is January 7th and the first account is purchases. So name of the account to be debited. So purchases followed by A/C and the word DR over here. So purchases account debit, and in the debit column 40,000. In the next line, you would leave some space. Then to cash account, this is the account to be credited, and in the credit column 40,000. And the narrative is being inventory. You can also use the word goods over here. Being inventory purchased by cash or being goods purchased by cash is what you can write over here. You can always write the narrative in your own language. So the entry is purchases account debit 40,000 to cash account credit 40,000. And the narrative is being inventory purchased by cash. I hope you have understood the application of all the rules. So we did see the application of rule of assets, expenses, capital, liability, and income. In case there is any doubt, you can leave it in the comment section below. I will be posting more videos on how to do journal entries based on these rules, that is based on the modern approach. A lot of videos based on the traditional approach have already been posted. You can refer to that also in case you're learning those rules. For this, I will be posting more videos. I hope you found this video useful. If you liked the video, then give it a thumbs up and subscribe to our channel. And do press the bell button to stay notified about all our future videos. Till the next video, bye-bye.